The whole purpose of this section, I'll give you a real good example. If you had an account receivable on your books, and you have $20,000 in accounts receivable. However, of that $20,000, if you were to really look at it, how it was broken down, you know that one customer, whoever that is, say it's John, he owes you $19,000 of it, and this was way back in 1970. It's very misleading to anybody looking at your books that you're expecting $20,000 to be coming in. Makes your company look a lot better off than it really is. You're not expecting this money to come in. That's where we have this new account that we're going to be discussing, one of the two new ones. Bad debt expense. It's an expense, as it says. It's designed to show that we made a sale on account, and then for whatever reason, that customer doesn't pay. Happens all the time. That's why you have collections and whatever else. I mean, there could be the person died. They went to jail for a long time. I don't know. They went bankrupt. But there's very good odds that in your business you're going to have something like this. Money that's not coming in. To do this the right way, what GAAP calls the accrual way, is we're going to show that we had the revenue right now when we got it, but we're also not going to be so ignorant that we think we're going to collect all of that. So we're going to set up and use this allowance method. We're going to set up a new account. It's a contra account. I have it up there and I'll put it over here. If this was account 110, we're going to set up an account kind of like accumulated depreciation right next to the parent called Allowance for Doubtful Accounts. It's a long one. It's a long title. I usually abbreviate it, but I'll spell it out this time. Or most of it. Allowance for Doubtful Accounts. It's a contra account. This allowance method is telling whoever's looking at our financials that yes, we know we have some AR up here and we hope to collect it all, but this is telling you our best guess of how much we probably won't collect. We don't know who isn't going to pay us, but we expect about this much to not come in. And then, of course, with this type of an account here, we would have what's called write it off. We would have removed that $19,000 after 2 to 3 years, or probably the most. When we have to kind of guess, you'll see what I mean kind of more in a minute maybe, but I like to think of this as the unknown account. I don't know who's not going to pay me. I just know there's going to be some dollar amounts that's not going to come in. When I actually determine who isn't going to pay me, that's when I write it off. If you've ever heard that term, you write it off. You take it out of their account and write it off of their account. That's what you're doing. This one, you're kind of just estimating. And you're estimating saying, I think this amount will not come in. I just don't know who yet. So when you write it off, if you write off this $19,000, it doesn't go over here to bad debt. You've already approximated it throughout the years, saying a little bit of that isn't going to be coming in. And how we're going to do that is there's a couple of different methods, but we're going to focus on one of them called the aging of accounts receivable. The aging of accounts receivable method. If you've ever seen like a doctor's bill, and you get a doctor's bill at the bottom, sometimes they say 0 to 30 days, 31 to 60 days, showing you how late you are, or if you're not late at all. Hopefully you've seen that before. 60 plus days. Well, I can, or the accountant or whoever's taking care of their books can look at that and determine how unlikely is it that you're not going to end up paying. Well, let's look at this from our sheet, one of the handouts, number 30. So it's the second page of the bank rec, right below the change fund. Our business, in our example, has an account receivable balance of $56,500. Now, we would be able to drill down if this was our own company, and I would be able to determine who all that $56,000 is. Part of it's to Susie and Bills and whoever. Okay, I just lumped it all together here. And then what I give you is I broke down that 56.5 into number of days late, or since I have issued the bill. So most of it's within 30 days still, which is very good. This is something that management has to determine, kind of like depreciation, useful life. Remember, management decides, yeah, I'm going to be able to use this for 10 years or 5. Same thing here. They look back to their clientele and past business experience, and they say, if somebody hasn't paid me yet, there's a pretty good chance that they're still going to pay me if it's been less than 30 days. A little bit less chance if it's a month or 2 late. And then all the way up, if it's 90 plus days, there's about a 50-50 chance I'm not getting that money. Okay, that's all management has decided to put those percentages in there, and they have to be able to do that. Now what we need to do is actually get the dollar amount. How much in dollars will be uncollectible? 1% of 50,000. Just move the decimal 2 places. That's easy. 500. 2,000. $300. 15%. 600. At 20% for $3,000, and the last one, $750. You add all that up, you get $2,150 that I expect to be uncollectible. So, whose account do I write that $2,150 off of? Whose account over here? Is it Bill's? Do I need to write $2,150 off of, or was it Susie's?
You can't. Right off.
I don't know it yet. You're right. I don't know. That's what I have this account for. It tells me I have a beginning balance of $1,000 from last month carried over. Do you think, what's this number then? Is that how much is just this month?
$1,150.
Yeah. That number there, $2,150, that's not a journal entry. That's my new total. That's what I should be at. Now I need to do the journal. What do I need to do to get from 1,000 to a 2,150? Yeah, what do I need to do? Add it or subtract it? Debit or credit?
Credit.
Credit. Very good. Wrong. I need to add 1,150 to the 1,000 to get to 2150. If I'd subtract it, then I'd be in a negative over here.
Yeah, sorry.
And I put that 1150, it's corresponding up here in bad debt. So my journal, bad debt expense for 1150, credit my allowance for doubtful accounts.
So, I have a question.
Mhm.
If that equals 2150, where was the 1,000 at to begin with? I mean,
The
I know that that was the beginning balance, but all those right there add up to 2150.
Right. Last month, all these numbers were different. Last month, this was 48,000, and this was 1,000. And when I added them all together, they equaled $1,000. These
This
numbers.
is accrued, okay, accrued,
And so it's gotten kind of worse.
okay.
Or maybe last time they equaled 3,000, and then you'll see how I got to the 1,000 in just a second.
Okay.
Because when we come down here, we got a letter from Jason's lawyer. Jason was one of the guys that owes me money. And on his specific T account, Jason's AR, he owed me $450. It's never going to come. He's declared bankruptcy. It's been wiped out. $450 needs to be taken off of his bill. It's not going to come in. I can't continue to show it if I know in good faith it's not coming. So one of the things I definitely have to do when I know for sure this person's not going to pay me is I got to remove it from their account. That's my credit. What do you think my debit is? Okay, allowance. What? Anybody else?
Bad debt expense?
Bad debt. Have I already accounted for this $450 somewhere?
Yes.
I have. Jackie's right. I accounted for it right here. I just didn't know who it went to. Now I know of the 2150 that's unknown, it's no, 450 of it is no longer unknown. 450 of it was Jason. So, Melissa, that's where this number came from, this 1,000, because now I'm down to 1,700. When I start next month, this is going to be my new $1,000 beginning balance. Every time I make some adjustments, then I'm going to have to do this next month, and I'm going to get a new ending total and add that, whatever the difference is, to my bad debt. So usually after a month, I'm going to keep writing it down, and I'm going to be about back to where I started at 1,000. I'm probably going to knock somebody else's account off within the month as well. So my journal entry here, debit the allowance for doubtful accounts, it's no longer unknown, and take it right off of Jason's books of his AR account. Key thing to remember with this one is always know or be able to look into the whatever is given to you. Know what your beginning balance is. And know that what this number is your new total. So many people want to use this as their journal entry. That's not the journal. We didn't add another 2150. That's my new total. I had to figure out what I needed to add to get to that total. That's the biggest place where most people falter on this one. last idea, or last new area that we're going to look at is interest receivable. Interest receivable. We're looking at it this week, and then in a couple weeks, we're going to look at it from the reverse way, as the client. This week, we're looking at it from like the bank or whoever is loaning the money, the loaner. We're looking at it from their perspective. So I, as the business, make a loan to my customer, and then I charge them some interest. And I need to be able to account for that. The first thing we definitely need to know is, what's our interest formula? I equals what?
Oh God, I forgot.
Think back to your
Rate
math.
times time.
What?
Rate times time.
PRT.
PRT. I missed one. Principal.
Oh, sorry about that.
P times R times T. And T is always in years. So if you see a 1 in that column, that's 1 year. If you see 1 over 12, that's 1 month. Principal, so whatever your principal is, how much you still have to pay. That doesn't mean it always stays the same though. Principal can, especially if you're paying like on a mortgage or a car, your principal should be going down a little bit every month. So your principal times your rate times your time. So on 7-1, we provide a loan to Jackson, one of our clients, for $5,000 at 12% interest. And then all we require is him to make a lump sum final payment of everything that's due in 1 year. The first entry should be pretty easy. Remember, I'm making the loan to somebody else. What am I getting from that customer if I provide them a loan? Yeah, since it's less than a year or less, I'm going to be getting accounts receivable, but on this one, we could definitely call it a notes receivable because it does have interest, and you can have short-term notes. So if you call this AR or NR, I would be okay. Probably the most accurate would be note receivable, and it being short-term, a short-term note. They gave me a note saying, I will pay you back $5,000. Why did they give me a short-term note saying they're going to pay me back $5,000?
You want to make money off your interest?
Well, but why are they going to pay me $5,000?
Because we loaned them.
They didn't buy something.
We loaned them $5,000.
We gave them money. Yeah, we gave them some money. My first entry isn't too hard. So we have enough money to loan some company from previous transactions, and we give them $5,000. Now, it would be incorrect if the next entry I did was on 6/30, because that's neglecting my year end. As of 12/31, how much have I been paid by my customer?
Zero. Nothing.
Nothing. How much have I earned from my customer?
Nothing.
I've earned something. This is kind of like wages expense and wages payable. Just because I don't pay my workers at the end of the year doesn't mean I don't owe them for work that they've done. I have provided a loan for 6 months.
What do we have that 12% interest?
Well, you can do it like that, but let's see how the interest we got to calculate. Principal, 5,000, times our rate, 12%. Remember, percentages as a decimals, just move it 2 places, the decimal. Times how many years?
6 months.
So how do I write that?
1/2.
1/2, or 6/12, if you want to do it in a monthly format. 6 months out of 12 months. So how much interest have I earned that I need to show on my books?
$300.
300. Okay, so what am I going to call that? What does the customer owe me? What is it called? Interest. So what am I going to call that up here?
Interest payable?
Not payable. That would be if I owe them
Oh,
money.
receivable.
Interest receivable. Interest receivable to my same customer, Jackson, for $300. Why do they owe me $300?
Because they accrued it. 'Cause
Yeah, what account am I going to use? Why is there a $300 adding on to their bill?
you add that to the notes receivable.
No, I don't want to add it twice to their bill. They now owe me $5,300. Why do they owe me $300? Interest. I'm doing my job as a loan company.
So sales revenue.
Yeah, but we don't call it sales revenue because it's not a sale. We call it interest revenue. I'm doing my job as a loan company. That's how I make money. Some people sell merchandise, some people do services. I loan money in this particular example.
Wouldn't you break that down in the monthly payment stuff? I mean.
Not necessarily. Companies, you may have a one-year loan. Yeah.
You just not have to make any payments, and as long as you have the full amount in by that year, then you're.
Right. Yep. That happens when you have like 12 months, same as cash. As long as you paid it off within 12 months, they don't really care exactly when they get the money. They'd like to have it in certain, but as long as you paid it off within 12 months, there's no interest. Kind of the same idea here. Now, we've got another 6 months. That means there's another 6 months of interest that I have earned. How much did the what did the company get on 6/30?
Cash.
Cash, right? How much cash?
5,600.
Oh, good, 5,600. We got back the original 5,000. Let's figure out where this came from. The original 5,000 from the note, 300 from the interest receivable from last year, and then the other 300 from the new revenue. And that's basically what my credits are. That is my credits, just like doing the sales when we had a breakdown of AR. Part of it went to sales, part sales tax. So I brought in 5,600. My notes are gone. Interest receivable, gone. And in 2015, or whatever year we are, I have another $300.
Why wouldn't there just be 600 in interest revenue instead of?
Well, because I had to break it up. Remember how the income statement at the end of 2014, I have to stop it. And then I have to do the closing entries. So in 2015, I only earned 300. I don't want to show that I earned 600 in 2015 because I really didn't. I earned it in 2 years. Okay, let's do the second one as very similar, except this is a 9-month loan. The first one should be the easy one. It's just like the first one on the other one. The customer gave me, what did I get? A note receivable from John for $4,000 because I gave them cash. Now try to take a minute and do that next entry. On 1231, you need to do the adjusting entry. This is an adjusting entry. Something you could definitely have on your take-home project if you want it as an adjusting entry. Anybody get an interest for that first 1231 entry?
$160.
160. I don't know. I haven't done. You got 162.
900. I'm losing it. Never mind.
Somebody who's not losing it, how much did they get? Anybody match 160?
I got 160.
Okay, good.
Yeah, okay. 160.
Interest receivable, we take 4,000 times 16% times how many months has transpired so far? 3. How much cash did I get?
4,480.
4,480? I think that sounds about right. I need to break this cash down to see if I actually did it right. Let's see. Where did the cash come from? Part of it came from my note, my original loan, 4,000. Part of it came from the interest last year. And the rest of it came from 6 months of interest this year, which equals 320.